Come on, Morningstar. Man, you can do better than this. So far, they've been doing this for a while. Pet peeve of mine about the financial planning / investment industry. It's one of the, all right, so Morningstar has this, quote, study, unquote, called Mind the Gap. And their assertion is that basically investors, they didn't say this specifically, but I'm going to say it, are so dumb. They underperform their own investments by basically almost 2 full percentage points, so 200 basis points. Dude, I hate that study. I hate that idea. It's just so stupid, I'll tell you why. There's another firm that used to do this, they probably still do, called Dalbar, D-A-L-B-A-R. And back in the day, when I was trying to drum up business, dude, I used to buy into this. I said, well, here's a study. Basically, you, Mr. Investor, are so stupid that if you don't hire me to manage your funds, you're going to underperform your funds by 2% a year. And if your funds average, we'll just say 6% a year, you're only going to average 4%, and as such, you're leaving 33% of your portfolio growth on the table. And compound that year over year, that's a lot of money, so my fee is worth it. And a guy named Nick Murray, who I love, this was an area I disagree with. How dare I disagree with him? How dare I? I should, cancel him because I have a disagreement, but he used to do this same thing. It's like, well, if you hire me, the average portfolio is up 10, you're only up 8, and as such, if you hire me, the average portfolio is up 10. After my fee, you're up 9, so I increase your return by X amount of percent. I was like, more than covering my fee. Always hated that. Well, again, when I was trying to drum up business, I used to do seminars. I used to focus on that, the Dalbar study, and then stupid Fidelity study that said you're going to need $286,000, and that doesn't cover long-term care costs for health care and retirement. And just, I didn't know what I was doing back then, all right? It was 2004, 5, 6, and 7. I just said, well, anything I can do to basically scare people to come talk to me. If they can fog a mirror, I want to talk to them. If I can scare them enough to hire me as their financial advisor, they'll be better off. And I did, and I still believe that. I just don't think fear is a good sales strategy. I just don't. I never liked that sales strategy, and I've since learned. I've since progressed, if you will. But anyway, so the Morningstar study is faulty in 2 ways in particular. I was just reading this white paper. I don't even know what the hell it is, some paper, research paper from some professors. And they, University of Florida, I think University of Arkansas, and a couple other places. And they show why the Morningstar study is wrong. The Dalbar study is the worst, and Kitsis had done an article probably 10 years ago, if not longer, showing why that was wrong. Kitsis.com, nerds I do. All right, got a big truck, big school bus, no? Woo, that's nice. Yeah! Oh man, he's on them rocks right there, yeah! Oh, you smell that diesel. Oh yeah, electric vehicles. Come on. Some guy trying to tell me they're going to have electric vehicles with be able to mine lithium with just battery power. I said, where's the, first of all, that's just silly. But okay, let's just say they do. Where's the electricity for those batteries come from? It's not self-perpetuating inside the battery, man. It's got to come from someplace. Where does it come from? Well, we got to generate it. Yeah, exactly. How do you generate electricity? Solar photovoltaic, wind. Yeah, okay. We're done here. But it's just a matter of time before the battery technology replaces the lead-acid batteries, and we don't need diesel anymore. Yeah, I hear you. I've only been saying that for decades upon decades. Then they'll make an argument, because I don't like electric vehicles, in terms of, I don't care, you can drive one, I don't care, I'm not driving one though. Why? Well, you are like a Luddite. The electric vehicles is an improvement over the ICEs, similar to the ICEs is improvement over the horse and buggies. I'm like, okay, Kamala. Remember when Kamala did that freaking talk where she said, the cloud, she literally thought, our storage is up in the clouds. It's in the sky, in the cloud. Because data centers don't require any big electricity or anything like that. They just, up in the cloud, it's up there, in the cloud. Again, today's with about 4 o'clock on election day. You heard it here first. Still think Kamal's going to win. We shall see. But I've lost like 13 subscribers from that video I did yesterday talking about Kamal. I think she's going to win. I mean, it's like, dude, just because I tell you what I think, not that I'm going for, you're going to unsubscribe to your buddy Josh? Okay. Whatevs. Anyway, so going back to the Morningstar thing. There's 2 major problems with these studies that show you that mutual fund investors are too dumb, and so they underperform their own accounts. Is that this one, it can't measure daily activity. So essentially what happens is, let me just tell you how this works. They're basically taking, I'm walking up a hill. Dude, it's the best time of year, man. Best time of year. So I'm going to get tired here in a second. So what happens here is they measure the net asset value of a mutual fund on the first of the month. They measure it at the end of the month. And they say that's your rate of return, all right, essentially. So if you start with 100, and now you're up to 150, your rate of return is 50%. Just using that for example. Don't take me too seriously on that, but that's how they do it basically. Now, they'll calculate for net flows and stuff. But the problem is they can't do it on a daily basis. So the trades all have to be done at one time. And that's at the end of the month. So they're basically lopping, I don't know, whatever it is, combining all the trades that went into that fund, the net flows, essentially, and they're combining it to happen at the end of the month. So inherently you're buying at the end of the month prices. But the portfolio investments has an upward bias where investments go up about 55% of the time on a daily basis. So if you're using your trades at the end of the month, you're missing out on those 30 days of a 55% per day upward bias. That doesn't make any sense. There's a little bit more to it than that, but you get the gist. You start with 100, you end with 150, you put 20 bucks in at the end of the month, you missed out on all that gain other than the last day of the month. And as such, you're missing out on the total gain of your portfolio. You're like, but that doesn't make any sense. Anyway, that's what they do. Now, the problem again with that is some people put money in, so then they'll assume because your rate of return as an individual investor is lower than the fund itself, you've been making bad choices with your money. I.e., your market timing strategy sucks. And you're like, dude, all I do is dollar cost average. Every week, every 2 weeks, every month, I throw money in there. That's it. Not market timing. I just put my money in. Put my money in, put my money in, put my money in. There's no market timing here. Stupid. So the idea that the average investor underperforms his funds by 200 basis points due to market timing is just stupid. Most investors are just dumping it in each and every month, each and every month, each and every month. It's dumb. Part 2 of this is when you factor in distributions. They assume people are buying and selling, chasing returns essentially. Well, what if you need a distribution to fix your freaking toilet? I could take $100 million out because in Biden economy, that's what it costs to fix my toilet. Do you think I sit there and say, I don't want to offend Morningstar, so I'm going to wait till the optimal time? No, you haven't to take the money out. That's what you do. You pull the money out when you need the money. You put the money in on a regular basis. You pull the money out when you need it. Hey, and that's it. So how do they say, oh, you're an investor, you're stupider than your mutual funds that you own? That doesn't make any sense. And they do that. Never understood that. It's like, wait a second. So if I dollar cost average in, that means I'm bad at market timing. And when I pull the money out, it means I'm market timing? Or does it also mean I just need the money? It's that simple. And there's more money going in, going out, generally speaking. So essentially, guess what? My internal rate of return, IRR, will be less as the fund as a whole. But not because I'm a bad market timer, because I need the money. Or I get RMDs or something like that. Stupid. And then there's another thing that just drives me crazy too about this when it comes to these ideas of investors being illiterate when it comes to owning their own funds. Your old buddy Josh. I got $10,000 in fund A. Mutual fund manager Joe Rich Guy has $10 billion in fund A. Who do you think drives performance more, me or him, in terms of the internal rate of return? Well, he does. Kind of like the S&P 500 is market capital weighted. The higher total capitalization of a stock has a bigger weight in the S&P 500. Rightly or wrong, it's just the way it is. So the mutual fund guy who's got all that money, hedge fund manager, whatever, or Mr. Rich Guy, Mr. Burns, excellent. He is driving a portfolio internal rate of return on the fund as a whole more so than me, because my $10,000 doesn't mean crap. So the average investor includes those guys who got the wealth in there. Now they might be driving returns back and forth because they are hot to trot with their money. They got hot money. Mutual funds don't want hot money anyway. They want cold money. They want money to stick. They don't want hot money. So I'm just like, well, that don't make it. So you're essentially labeling all investors are maroons because a couple investors, the heavy hitters, are bouncing back and forth. It's dumb. It doesn't make any sense. All right? I've never. And then in part that we'd talk about daily aggregates into the end of the month. We're talking about dollar cost average as opposed to market timing. We're talking about when people take distributions out. Oh, that's just dumb. And then finally, I'll never forget trying to talk to people, but this is 20 years ago. Yeah, 20 years ago. Like, oh yeah, man. You need to manage your money or else. And people are like, well, I've been in my fund for, we'll just say American funds. I've been in my American fund since 1988. I haven't done anything with them. You're telling me I've done worse than my portfolio? I said, well, okay, not really. Most people, at least my experience, they don't bounce back and forth. They just plug money in, plug money in, plug money in. There are some people, TSP, 403B providers, 401k guys and stuff, who are bouncing back and forth. The vast majority of investors aren't doing that. So that's why I don't believe the Morningstar hype. You as an individual aren't doing that. I can almost guarantee you that. And if you are, stop it. You can't market it. I just bought some PIC. That's the mining ETF today. All right, I put about $10,000 in there. Not a huge amount, but I still put some money in there. Just a play. I'm gonna hold on to it forever, dude. Forever, I don't know, but I'm gonna hold on to it for as long as I can. I'm not getting out of there. I hardly ever check my portfolio. In fact, I was surprised to see how much my portfolio has grown since the last time I checked. I was like, wow, not too shabby. Your old buddy Josh. Have I done anything? No, I haven't done anything. Just put it in there and let it sit, reinvest dividends, and I am good to go. Anyway, so don't let Morningstar or professional investor guys dissuade you, saying you are a bad investor. They don't know what to talk about. All right, God bless. What are your thoughts? Don't forget to, to MAGA that like button. MAGA it. We'll see you.